All right, so let's get this thing started. My name is John Kicklighter. I'm a currency strategist for dailyfx.com, here to give you the major fundamental macro themes for the currency market. And I could take this many different ways to explain this to you, because I like to keep it to a month to about 6 months looking out. More likely though, I like to keep it to about a month outlook. And in covering these themes, we can go back and forth across so many different currencies. So I can take it as what each individual currency is doing, or I could just take it by theme. And I think it's better to take it by theme so I can so I don't jump back and forth. And this is really the approach I'm going to take today. I've done both in the past. But we can really break it down into two different things, two different major themes that are driving the currency markets right now. And indeed, I would say they're driving all investment markets, all asset classes. And you can see the impacts of what I'm going to talk about today in equities, commodities, fixed income, obviously currencies. And you just have to look for what is driving the market. And it's very important when you're a fundamental trader or even a technical trader that just needs to keep a perfunctory look at the economics behind the markets every now and then. It's best to keep in mind what are the major themes driving the markets, because then you could start to point out and highlight those correlations. You can see how markets are going to move in correlation to each other, or perhaps even to assets like the dollar and the Japanese yen, how they're moving in relationship to each other, versus how the currency market is moving in relation to equities. You can prepare yourself for what the major financial drivers are going to be, what's going to drive volatility, what's going to determine direction, what's going to determine overall market activity. That being, are we going to have ranges, are we going to have breakouts, are we going to have just back and forth volatility? And these are the bigger issues that many traders tend to overlook because they like to zoom in on the 5-minute chart and try to scalp, or they are day traders and swing trade. But you always need to keep in mind these major fundamental themes, because that is the higher time frame that will keep you on track to keeping your trading strategy alive. So to start things off, I'm going to break it down into two considerable market movers, and then we'll start going all over the pairs while we talk about these themes, and we can do some maybe technical analysis at the end of this discussion. But the first major theme, and let me give you a chart. All right, you guys see this? This is the dollar index. Just tell me if you're able to see it. Okay, you can. All right. So this is the dollar index, and it really is playing in. I mean, if you're going to look for a major fundamental theme, you do so in the U.S. dollar for the currency market, because the U.S. dollar is sensitive to everything that's going on in the market, as it is the world's still the world's reserve currency, as well as the most actively traded, the most liquid. So we see the U.S. dollar, and we have to use this as a backdrop for determining what is the major driver. And the major driver right now, I would argue, is still risk trends, risk appetite, sentiment in general. And we can see this has been especially so over the past week, because not only has the U.S. dollar been one of the major drivers, or been reflecting general sentiment, but so has the Japanese yen. And I pull up a yen chart as well, so you can see that and see the kind of correlation between the two. And we'll go for the euro yen, as we don't want to have a dollar yen, because again, it makes things messy. So you can see that the Japanese yen has been backing off for quite some time as well. We did have some back and forth, and it's been relatively choppy, but it has shown a general bias lower, the Japanese yen itself. And this is exactly what we're seeing in the U.S. dollar. But the U.S. dollar has backed itself up against major support. And this shows that we are likely on the verge of a significant shift, whether it be towards risk appetite or risk aversion, over the next week or couple weeks, where we'll see a big change in sentiment, underlying the market. So first we got to see what really brought us to this point. Why are we backed up in terms of risk? Why have we come to this like breaking point, this edge of the cliff? And one of the most significant drivers, and we can see that really this happened last week when we started to pull off the congestion that we had 2 weeks ago. back around 81 as a high, it started all with earnings. Okay, there were a few other there was some other economic activities going on back then, some exogenous event risk, but it was really beginning with earnings. So let me pull up something that I've been referencing for quite some time now. Tell me if you can see this Excel spreadsheet. Okay, all right, good. Now you see it. All right, so this is a spreadsheet. I mean, anybody can do this. Anybody can make this. And I recommend that everybody do something like this. They always have what they're really expecting to drive the market laid out ahead of time. This is just a part of my fundamental plan and keeping track of things. So I made an Excel spreadsheet, or actually I cheated. I had my interns make it. But I have this Excel spreadsheet, and I told them I wanted every major earnings release over the past week up to the end of this month. Okay, so that really captures the entire second quarter earnings season for the United States. And really we can see over that first week when things really started rolling, and it all started rolling with Goldman Sachs back on the 14th, we can see that there was really it was a shot out of the gates. Okay, Goldman Sachs beat its earnings significantly, and that was the kind of pick-me-up that the markets really needed. So far, we've seen that risk aversion has been backing up. This does not necessarily means a return to risk appetite. It merely means that fear is still dissipating from the market. So then the quiet return of capital into the market that was been sidelined for so long during the financial crisis, during the congestion over the first 6 months of the year, can finally start to unwind itself, and it starts opening up to the market. So we can see that capital was coming in slowly, but when we had Goldman Sachs come out with a better than expected earnings, it really catalyzed a hope for return that can compensate beyond what we've seen in very low yields across the market. So there wasn't really necessarily the yields in fixed income, which currency traders obviously flock to when they're looking for things like carry trade, but we do have the ability to make returns through more traditional assets, more risky assets like stocks. And given the underlying stability of the market and the general rebound that it's been experiencing, this Goldman Sachs earnings figure pointed the sign that it was time to go. All right, and then we just had a series of blue chips and a few more of those TARP banks, those 19 stress test banks that came across the wires with better than expected earnings. We had Intel, Johnson & Johnson, IBM, Google, and among the banks we had JP Morgan, Bank of America, Citigroup. These had all given better than expected earnings, and this carried risk appetite going forward. But we saw that it started to back off towards the end of the week. All right, we did have a BB&T Corporation, which is one of the 19 banks that went through the stress test. It came in slightly under than expectations. All right, this gave the market just a little bit of a step back. It's a minor bank relative to its larger counterparts, but it did suggest that perhaps conditions are not as good as the Goldman Sachs or the Intel figure would expect. So fast forwarding to this week, we can see that conditions have already declined. We've had strong Caterpillar and Merck figures, for example, but you have DuPont, Regions Financial, State Street. State Street was a terrible report, and this morning, more importantly, we've had Bank of New York, which is another TARP bank, come across the wires. All these red highlighted equities are actually TARP stress test banks, and the blue ones are actually Dow Jones components. So we have Bank of New York came across the wires worse than expected. Morgan Stanley much worse than expected, but you did have a better than expected Bancorp and Wells Fargo. So it's not necessarily that we're going to see an immediate reversal in risk appetite due to the stabilization of expectations through earnings, but it does give us reason to pause and really second guess this advance in risk appetite. And we really have to consider what should we take away from these earnings? Are we really going to get the kind of momentum we need in earnings to drive up return expectations and profit expectations to really drive markets higher, to really drive sentiment higher, and force the breakouts that we're looking at across the different markets? Like you're looking at the Dow Jones. I could see, where can I get a calendar to stock earnings? Someone asked. You can actually, I just looked up all this data on Yahoo, Finance Yahoo. So that's easily found. But you can see that so many markets are backed up to a significant technical level that's preceding a major shift in sentiment. It's like upshifting the next gear towards a breakout for the Dow Jones Industrial Average, which was been flirting with 6 or 7 month highs yesterday. We also have the dollar index, which we were just looking at, and that's just about to pitch downwards. And obviously the dollar is still being treated as the world's reserve currency and therefore a safe haven, so it kind of moves inversely with equities and inversely to risk appetite. So that's what we're going to be watching going forward. But really taking away from these earnings, what does it say? We need momentum, first of all, to force the breakouts, but a critical look suggests that this is likely a sharp recovery. Immediate recovery that we're seeing in both blue chips and the financial sector, facilitated by government money. There's a lot of government money floating around the economy, and there's a lot of support there. This naturally helps these economies recover from their massive losses over the first quarter, the fourth quarter of last year, and so on and so forth. But this is not necessarily a sign that we're going to get a V-shaped bottom in earnings, just like we don't really expect a V-shaped recovery in the global economy. So that's something that we need to keep in mind, because after the initial recovery in these earnings figures, we're going to see them likely taper off going into the third, fourth quarters, because the expectations for growth is that it will move into a slow recovery, and it'll move into stabilization. Some even predicting a double-dip recession, but if it is going to be a double-dip recession, it's not likely to be as bad as it was over the decline that we saw at the end of 2008, beginning of 2009. But we also need to consider something for the financial sector. The financial sector has seen an uneven recovery, but we have seen some very bombastic numbers. We have seen Goldman Sachs, who has purposefully turned itself into a regular banking corporation so that it could access the TARP funds that it had to stabilize their bank and be able to access these funds and try to return to growth, strong growth. And we saw that now they're printing record returns. This is kind of unusual. It certainly has a lot to do with the government's money, and it certainly could have something to do with accounting. So there's going to be these kind of people are going to be skeptical going forward, as they rightfully should be, because you should not expect record returns after a near record loss. And this is what is going to be very important going forward. We will need to see whether there's consistency in these numbers, and we need to see whether just this season alone can force such a massive breakout. It very well could, but we definitely need to see ongoing returns of the caliber that we've had recently. And tomorrow we have a number of additional significant earnings releases, but not to the same level that we've been seeing over the past few days. We'll just watch Fifth Third and Capital One as major financial components, and there's also a couple blue chips there. But it may not have the kind of drive that we need to force a breakout in terms of risk appetite, to bring out risk appetite to that next level. And you'll see that obviously with equities, the path equities take from here on, as well as the path that the dollar and the Japanese yen take from here on. All right, so let's move back to our charts. We'll move back to this dollar chart. So we also have to think, look out there and see if earnings isn't the be-all, end-all of this kind of conundrum we're in, this technical conundrum, this conundrum for direction. We need to consider what are the things that can really balloon up and trigger a move going forward. There's a few things. Right now, immediately, we have to be concerned with the CIT. This is a U.S. commercial lender. CIT was at one time the largest commercial lender in the United States and I think in the world. So it does have its roots in the credit market. And we know the credit market can be unstable. Whether this is going to be unstable, this can unstabilize conditions right now it really, we need to see. I mean, I'm not going to say yes or no, but it's certainly with billions of dollars and debts and credit lines out there, it certainly could cause a disruption, and it could certainly send a trend like this, something where the U.S. dollar and general risk and appetite is on the edge, reeling backwards. So we got to see whether they can cover their $1 billion credit line that comes due, I think, on August 17th. I think over the entire year going forward, they have some liabilities on the order of $10 billion. And at current liquidity levels, they can't even cover that $1 billion next month. Even with the $3 billion that's going to be given in terms of through a private investment through their bondholders. So there are conditions here that are pretty unstable, but you can bet that the FDIC and the federal government in the United States is going to move things in place so that they can absorb this if it turns into a bankruptcy rather than a insolvency that really sends shockwaves to the markets. And that's what we need to avoid if we don't want to set off a panic that causes risk aversion to once again take over the market. But there are other things that we need to consider, longer-term things, and growth is obviously one of them. But that's going to be later on. But we also need to consider financial sector issues. Japan, for example, they say that Japan through the 90s and 2000 and most of the 2000s was a lost decade, and that's because they have been unable to really pull themselves out of their credit glut after their last financial crisis back in '97 and even before that. Their yields have been incredibly low, and they've struggled with bouts of deflation. They've not really been able to recover, and considering that now they've just seen a record recession. Are they going to be able to? Are they any better of a position to recover now? Unlikely, very unlikely, unless they dramatically change things around. But recently, we just saw, I believe yesterday, the Bank of Japan, with their minutes, suggest that they're starting to see the ability to start removing their three buying programs that they put into place to really stabilize the financial markets in their economy. This was probably a little early. I certainly think so. But we'll see whether this can actually work going forward. But they definitely have political troubles as well. They are going to have a general election, and it's very likely that the ruling party that's been in power for 50 years is going to be replaced, and no one knows how really the new government could in support or impact the economy and the financial recovery, how they'll play with the global financial crisis, whether they will facilitate it or they will take a more European stance and try to kind of fast forward the reduction of debts and withdraw financial support. So it's a big question mark about how this economy will perform, and it's important going for the entire currency community, because not only if you just trade the Japanese yen, but because it is the second largest economy in the world and the Japanese yen is one of the most frequently traded currencies, it has its ripple effects to every trade that you do in currencies. But we also have the Eurozone. The Eurozone you have to watch out for because they've forecasted another couple $100 billion, or 100 billion euros of write-downs for the Eurozone banks. This is largely overlooked, and even though German Chancellor Angela Merkel and all the other officials there suggest that they are seeing a recovery and that everything is back to normal and that they can start to work down their deficits, they still have major losses that they even admit to, that the Eurozone even admits to, and the IMF and other third-party sources suggest are much bigger than what European officials are forecasting. So there's a big burden hanging over the euro there, as well as Eastern European exposure to debt. Eastern Europe is kind of on the brink. They are struggling to avoid sovereign credit rating downgrades and defaulting on their sovereign debt, and that could cause major ripple effects for not only Eurozone, but for the broader credit community, the global credit community, but it will be centered upon the Eurozone, who has the higher amount of risk. And then also, I would never forget the United Kingdom. They're expected to really struggle getting out of their recession. They are still one of the most indebted nations, especially in the developing world, in the entire world. So they're one to really watch because they are going to be the most sensitive reading to the health of the global community, or the global economy, and the financial markets. And we need to really balance risk and the expectations for growth. And growth is the second theme, okay? Risk has obviously abated over the past 6 to 8 months, but you need kind of returns to offset and encourage investment against growth. So we need positive expansion. We need the yields that it brings, and we need the capital investment that it brings. Because if there is no capital investment, corporate investment, you're not going to have any outsized returns, and you're not going to encourage speculators back into the market. And then therefore you're going to stagnate, and you're going to see the currency market lose a lot of its volatility, and therefore you're going to see a lot of traders trying to go for ranges that perhaps will not provide returns that they need to stay profitable, because most retail traders are range traders. It's just the nature of the beast. So looking at growth, we have to benchmark growth. If you're going to trade one currency against the other, it's always the issue that you need to benchmark growth or yields or risks of one economy versus the other, and that's what we're going to do. We have many different forecasts from many different groups, but we definitely see that the United States is expected to see a more aggressive recovery than both the Eurozone and Japan, for example. But we already see that economies like Australia have actually avoided a recession altogether. They've printed positive growth in the first quarter. So we're coming into the second quarter GDP season, and we'll start to see these numbers cross the wires, and these will really be what the focus is on going forward. We have just coming this Friday, the economy that's expected by the IMF to be the worst performing developed country in the world for the rest of 2009, and that's the United Kingdom. Now, GDP for the second quarter in the United Kingdom is expected to actually worse. So the recession is expected to intensify. And this is really the only economy among its peers among the majors to have a forecast of a accelerating recession. This is a unique situation, and certainly speaks very, very poorly of the health of the British pound, because it has so many other issues to deal with, not to mention political and debt. But now I also have to see that its recovery is really being stifled, and it's not happening in line with the rest of the global economy. And if it doesn't happen with the rest of the global economy, if that global economy kind of levels off, and just when the United Kingdom is starting to rebound, it's going to make that rebound much weaker than it could have been if it had otherwise done so along with the rest of the world. So we will have to watch that number come out on Friday, and we have to benchmark it against what's happening with consumption. You got to look at the details in these figures because while you can see that the headline figure will give you kind of a sense of what has happened, it's the component figures and the development of the component figures that will give you the necessary tools to forecast what's going to happen third quarter, fourth quarter, and beyond. And so you're going to really want to see what's happening with capital investment, housing, and consumer spending. These are the three biggest issues in the United Kingdom. It's arguable that exports is an issue, but I would say that domestic issues in terms of lending, money flow, and consumption are the biggest considerations. Moving on, also we have next week the U.S. GDP number. This figure is expected to, GDP figure is expected to improve dramatically. It's still supposed to show a ongoing recession. We're not going to see positive growth yet in year-over-year figures, annualized figures, but we will see the pace of recession decelerate tremendously, and that's exactly what you want to see because while the people are saying that they see the initial signs of growth in monthly figures, you want to see it confirmed in these bigger readings, these more broad readings. And if we see that this recession is decelerating as expected, it will be a big push for the U.S. dollar to be considered one of the strongest economies among its peers. And that's a dramatic shift because it can change the whole perception of the U.S. dollar. Rather than being a safe haven and a liquidity provider, it could be in turn considered one of the economies that is recovering fastest and therefore can provide more returns. Still have to deal with the deficits in the United States. You still have to deal with the fact that the Federal Reserve is expecting to hold benchmark lending rates at its low level, its current low level, record low level, till June or so of 2010, and that will therefore deflate yields. But if growth is returning, capital investments will start to show gains, and that will provide returns and make a competitive advantage for the U.S. There's another series of releases that will come out for the rest of the majors, but it's going to be some time before we see them. The Eurozone and German figures do not come across the wires until about mid-August, I believe, August 13th. But we did see that the Bundesbank, Germany's central bank, had actually suggested that their economy through the second quarter, by their initial accounts, had actually contracted only slightly through the second quarter. I mean, that's tremendous. That's much better than the United States, but you kind of have to take their expectations with a grain of salt because we need to see these confirmed in GDP numbers, but it does put them on a good path and a good pace for recovery. This could overwhelm any kind of dollar advance, but considering that you have so many weeks between the U.S. release and the Eurozone release, we may have already made our move, and the U.S. dollar may have already appreciated against the euro. So that's something to watch going forward. And the rest of the GDP numbers will start kind of trickling across the wires, but you want to take it in terms of how each one is doing in terms of the other. So whether the Eurozone's growth pace is improving faster than the U.S. or the UK is starting to show recovery where the Eurozone is not. These are the types of things that will be an underlying current. But you also want to take it in terms of how is global growth progressing. You want to see not only how is the U.S. doing, but how the entire world is doing. Is it recovering? If so, we will see capital start to return to the market because you can expect consumption to revive, employment to revive, capital investment to revive, and therefore there's going to be more speculative funds. There's going to be more capital inject into the market, and that's what will really start to drive volatility again. That will start to drive the markets again. So that's really the major themes that you should be watching. And I can see it's already 8:30. I could talk forever about this, and I give you as many charts as you want, but I really don't know. I don't have time. I don't know. Do I have time to answer any questions, Vicky or Maud, if Maud is here? Oh, I have time. Okay. All right, so if anybody has any questions, I can answer them, or we can look over some charts or something. I have tons of charts that I definitely have drawn up already. All right, so first let's take Dudley's question. If the UK economy is so bad, do we expect the pound to fall against the other main currencies in the near future? That's a good question. Now we're talking about expectations and speculation versus current figures. All right, I'm sure you're familiar with the term trade the rumor, or buy the rumor, sell the news. I mean, that's more popular amongst the equity crowd, but it pertains to all speculative endeavors. We already priced in, let me pull up a chart while I'm talking about this. We've already priced in, or the market has already priced in, the problems that are going on in the United Kingdom. So you need to consider that the market's already fully discounted a ongoing recession. How fully they've priced it in is unknown. There's always a buffer zone that even if GDP came in line with expectations on Friday, it could still cause a rally or a decline depending on where the market was really moving in expectations to economists' expectations. It's difficult to tell what the market is expecting in terms of growth or pricing in terms of growth. You kind of have to just get a sense of it by seeing it over time. But I would say if you have a significant decline in some of the components, I would say look at the consumer spending and look at the capital investment specifically. You see declines there. You're going to see that the British pound is going to be selling off pretty substantially, especially if we start to see the other currencies that appreciate, like the United States and the Eurozone. If they show that their recovery is underway while the United Kingdom isn't, then the pound is really going to start losing ground against its major counterparts. But right now, you also have to consider that the pound has kind of its roots in risk appetite. It's been advancing against the U.S. dollar as well as the Japanese yen, and that's because the British pound stands to benefit the most should global markets and the global economy start to recover, because they will be able to improve their trade, exports will improve, capital will start to flow in and buffer the economy naturally, and they will be able to see their recovery and work down their debts, because right now they have their real only option to help themselves is to spend more money and to fortify their recovery, and they really cannot afford to do that. So we see that when risk appetite rises, expectations for growth rise, therefore the British pound rises. All right. If we see the recovery is starting and the USD goes up, then stocks will also go up. It will no longer be USD up and stocks down. If you start to see the U.S. dollar, it will be hard to shake off its safe haven status. Okay. The safe haven has been deeply ingrained to the U.S. dollar, not just because it was the source of many carry trades or anything like that, like the Japanese yen was, nor even that it's the largest economy and has treasuries backing it. It has more to do with the fact that it's the world's reserve currency. It is the pricing mechanism for nearly everything. Commodities. If you're trying to make a third-party currency transfer, oftentimes it's through the dollar. The dollar is traded, I think, is almost 3/4 of the time going to be in any currency transaction you perform. So you have such a dependence on the U.S. dollar that it's going to have to be a safe haven currency. It's going to be that currency that is based upon everything else. So right now it's a return to risk appetite. So the U.S. dollar is the foundation for that risk appetite. You will borrow U.S. dollars and then you'll fund that risk appetite. So people will, if you're talking about large capital pools, they will liquidate their treasuries and then they'll start buying Australian bonds or New Zealand bonds or something along those lines. So the U.S. dollar will have a very hard time removing that safe haven status, but you will see that as it starts to show signs of recovery, as the global recovery starts to take place, it will start shifting towards breaking that correlation. and you will see that the U.S. dollar will not move so will not have such a strong negative correlation to stocks. That correlation, that relationship will start to break down over time, but we do need to see growth recovering in the United States, and we will need to see growth recovering for the broader economy. I see that someone's asking, when do I see the recession ending? It depends on what you consider ending. I do see it recovering already. I see that I think that the worst has passed. There are some hiccups that can happen along the way, but I do think that we're recovering for good in this cycle. But that does not mean that we're going to return to the boom years between the dot-com bust and the what's been termed or coined the Great Financial Crisis between 2007 and 2008. Neither do I think it will be anything on the par of any of the recoveries that we've seen over the past 2 or 3 decades. I think it will be a stagnant recovery. It will be a real flat recovery, and that is going to really impact your investment conditions, your market conditions. You're going to see that volatility is probably going to be held down. You're going to see that it's going to take a long time for yields to recover. So you're not going to have these high-flying returns that we had over in the 5 years preceding the 2007 collapse. So you have to adjust your trading strategies accordingly for a couple of years, and I think it's going to be probably range trades and short-term breakouts and just lowering your time frame for trades. What do I think about the economy of Germany and the Eurozone, I guess? For Germany, the economy is improving. It has seen. It's kind of a practice in economics that they've only had the Eurozone for since 1999. I mean the Euro for 1999, but they've had the European Union for quite some time. But giving these kind of powers to the ECB since 1999 has shown its impact. We still have some significant deviations in growth in terms of like Spain and Italy in comparison to the Eurozone and France. Germany and France. But you can see that generally growth has been able to, regional GDP has been able to stabilize itself. And I think that that is a good thing, but in the recovery, many of the policy officials are being a little aggressive in withdrawing their support of this recovery. That it could be very dangerous. If the German Chancellor Angela Merkel continues on her hard line, reduce deficits, and work off the support that she has put in place, it could have negative impacts should we actually be looking towards a double-dip recession for Germany or for the global economy. If that happens, they're going to be caught with significant problems, and these declines will immediately start to amplify themselves in the German and Eurozone economies, and then you'll see that removes support, that backdrop, that safety net that they had is gone, and then it's going to immediately turn it into something much worse going forward. And it will not necessarily make it a second recession as bad as the first one that we are just currently getting out of, but it will definitely set them back against, in relative terms, to the United States, the UK, and other major economies that keep their stimulus in place. Let's see. Is it an irony that the U.S. can go on printing money to spend, and yet the U.S. dollar is a safe haven currency? That is a good question. It is ironic, and it's certainly unfair in terms of global politics and as well as global economics, realistically. But you need a safe haven. It's absolutely necessary. You can't get away from it. They're going to try going forward to swap out the U.S. dollars as the reserve currency just for this reason. And I think it's going to be a very slow process. But it certainly cannot be helped. If you did not have this safe haven, it would make it progressively more difficult to do business internationally, because that there wouldn't be that common medium exchange. It'd be kind of like giving up your fiat currency to trade for 6 different things. You kind of have to know the value of each thing going forward, and you don't really know which one's the correct value. So if I told you, if I told you to look at a price of crude right now, you'd be looking at the price of crude in terms of U.S. dollars, most likely. You wouldn't think to look at in terms of euros or pounds or Australian dollars or Japanese yen. And that's kind of how business operates. And to change things around would cause incredible inefficiencies, but more likely it would cause more problems, and it would make things much more difficult and harder to value. Valuation and transparency is key to the operations of the market, the efficiency of the market. So you kind of need to keep that dollar, or going forward, you need to have an equivalent that can be considered that reserve currency, that benchmark. Do I see the euro and pound strengthening versus the U.S. dollar? Well, let's look at the euro first. We have the euro chart here. This is what I've been looking at, and I don't know if any of you guys read our stuff on or watch our videos on dailyfx.com, but I've been on the fence about this. Obviously, with what I've been saying about risk appetite, that comes into consideration. That's going to be very important for the euro going forward. But I have been kind of fading this trade with a reduced position size. So I'm not trying to take an outright position. I'm trying to play the probabilities here. That's how I always come to approach a trade as, what's the likelihood that we will see a breakout, or what's the likelihood that we will see a reversal? That's always an issue that can never be a 100% guaranteed thing. So I don't try to treat it as a 100% guaranteed thing. So right now, what I'm doing is I have faded this trend and put on a reduced position size, and if it accelerates into a reversal, I will add to that position. But I do have tight stops fitted right above yesterday's high, and I have breakout orders set, I think, 75 or 80 points above that trend line. So I'm kind of sitting on the fence, but fundamentally, I think that the U.S. dollar will actually recover against both, specifically because I think risk appetite is going to back off going over the next couple of weeks. But you also have to consider next week when we have that U.S. GDP number coming across the wires. So you'll see that any advance that the U.S. dollar makes on earnings alone will probably slow, and it will stall out most likely just ahead of the event, or a couple of days ahead of the event, because people are more concerned about what happens with GDP. Let's look at the pound just to get some technical flavor on that. Same thing here, but the British pound, I'm not going just on risk appetite. Much greater risks in terms of the second quarter GDP due on Friday. I am more concerned about congestion. The British pound is going to be highly sensitive to risk sentiment going forward, but with that GDP number, you're going to see that correlation is probably going to break down for the rest of the week. Instead of trying to pick a direction, I will take a direction after I see a breakout, and I consider that breakout like 160 to 166. And until then, you're just going to get choppy price action. It's probably not worth it to trade. Let's see. Do you think there is to be a new world reserve currency, and when? I think that there will be a slow progression towards a new world reserve currency, but it will take some time. It's obvious that there's very big inefficiencies with using just one currency, the U.S. dollar, because there for those currencies for those economies that peg against the U.S. dollar for their own currency, or trying to price something. They're highly exposed to the health of the U.S. dollar, and that's kind of a problem because it obviously it amplified the financial collapse and the economic recession. So we will see people. I mean, we've already seen a number of officials have been trying to push forward through a new currency. Reserve currency, but that can't happen when things are so disjointed and so unstable. But you will see a slow progression, just like we've seen. China has started to to use its own yuan swaps for certain things, for certain business orders to a certain amount, and you'll start to see things like this happen. But when conditions start to stabilize and growth starts to stabilize in the long term, you'll see that there's going to be more talk about SDRs or other reserve alternatives. It's going to be very difficult to find a reserve alternative that works, and it's going to be extremely difficult to get everyone to cooperate. Those are going to be the problems, and it's going to take not a couple of years, but 5, 10 years, 15 years for that to work and work efficiently. All right, so I should wrap this up. Thank you for your time, guys. If you have any questions at all, you can always email them to me at jkicklighter@dailyfx.com. You can always read my contact